People Not Titles podcast is proud to be sponsored by Land Trust Title Services, your partners for results.
All right. Well, hello, everyone. This is Steve Kaempf with the People Not Titles podcast, and I'm really excited today. Coming right out of the gate, January 3rd, this is being recorded, to have a president and CEO of Commercial Lending X, Brad Hedich. Brad is a referral partner of ours. He's a good friend, and he's a person that really has his finger on the pulse of just where we are from an economic standpoint. And so, Brad, I'm really elated to have you here. Welcome.
Well, thank you so much for having me, and Happy New Year to you and everybody listening to the podcast.
Absolutely. You know, I heard this morning, Brad, that today, according to Larry David from whatever the show is,
Curb Your Enthusiasm?
Yeah. Curb Your. He
Okay.
said that January 3rd is the last day that you're allowed to wish people Happy New Year. So we got that right under the wire here. So I know, isn't that silly and stupid, right?
Well, it's going to be the lead-in for all my emails planned for the next week, so I may surpass that date.
There you go. Larry David wouldn't like it, but what the heck? Okay. So, Brad, what I'd like to do, I received this great email that you sent out, which kind of summarized a lot of the economic things that we've endured over 2023 and then kind of projected forward into 2024. And I wanted to tease that out with you. And so why don't we first just do a look back on 2023 and talk about what kind of year it was for you, what you saw in the banking world, and how everyone was impacted by that.
Yeah, so let me start off by clarifying that my perspective is really coming from that lending perspective, and then
Yes.
working with business owners and real estate investors. So I'm not gonna tell all the tidbits on the economy because I'm not an economist by any means. But from a banking perspective, it was really a very interesting year. And really, I would say going back to 07, 08, this is probably 2023 was the most interesting year as far as just dynamics of what happened in the industry. And it started pretty early on in March with kind of the whole issues that came up regarding bank capital and the pressure banks were having to maintain deposits. And it really created an issue and a ripple effect through the banking industry. And very early in the year, it caused banks to have to get more aggressive in building deposits and reserves, and caused interest rates to go up dramatically because over the year, the cost of those deposits went up. But on top of that, you had several bank failures. So it also caused a lot of banks to become very cautious in their lending and very conservative with doing new loans, both because they were trying to preserve capital, but also because they were deeming that there was some risk out there that may cause them some future problems. And the problem only got worse as the year went on.
Brad, can I pause you there? So just in a summary to that, banks are looking for more deposits, so they're paying more to attract people to deposit, which means that now they have to what they are borrowing, they have to get a bigger to make their margins. They have to get a higher interest rate, and so that now just means that things are tightening up. They have to be more selective of who they're giving that out to, and anyway, so now we're shifting into the next phase.
Yeah. So then on top of that, you also had interest rates go up. I mean, the Fed raised interest rates several more times during the year. It had a huge impact on anybody who had variable rate debt. Your most common variable rate debt is business lines of credit. So that's capital businesses use every day to operate. You go back to 2021, that debt was around 4%. Now today, that debt's between 8.5% and 9.5%. And the second biggest group is small business owners who borrow via the SBA's 7A loan program or some of the other SBA programs, or some of the non-bank lenders out there that do variable rate debt. Some of that debt can be priced as high as prime plus 3%. So with prime at 8.5%, you're looking at 11.5% on debt. That's pretty substantial, especially for companies that have a lot of debt. I mean, if you did a business acquisition, say in 21, and at the time you borrowed at prime plus 3, which was 7%, and now you're at 11.5, that's, it's a 4.5% increase on $1 million. That's $45,000 a year. On $5 million, that's over 200,000 more a year. So that's very impactful to business owners.
Yeah, and Brad, it's not like people thought that interest rates would remain low forever, but they did not expect it to go up so quickly, right? I mean, that really is that was the splash of cold water in everyone's face.
Yeah, I think so quickly and as high as they went.
And as high as they were. Okay.
Yeah, and it's very interesting with everything that happened between banks having to pay more for deposits, interest rates going up. We ended up in this situation now where I'm seeing the largest spread in fixed interest rates from banks that I've ever seen in my 25 plus year career. We have banks right now still fixing fixed rate real estate debt in the mid to upper sixes. We have other banks fixing it at 9%. You're talking about a 2.5% spread. Normally that spread is, somewhere between 50 to 100, maybe 150 basis points, but now we're at 250 basis points. And it's just causing a lot of disruption in the market. And it's a challenge for a borrower who may be like, okay, my bank's now doing a deal at 9%. I hear other banks are at 7.5%, but do I want to test the market? Because I don't want to lose this banking relationship I've had for 5 years, because if I go to another bank and they do give me 7.5%, are they going to be loyal to me if I have a problem a year from now?
Yes.
So it's really a challenging time, and it's going to be interesting to see what happens in 2024.
Yeah. And before we get into 2024, Brad, part of what you do is help people through those challenging times, right?
Yes.
In terms of really consulting, because of your background coming from the banking realm and now coming in from a standpoint that you have access to a number of different money sources, you have the ability to help people navigate those waters, fulfill whatever kind of short-term needs they have and maintain their important relationships as well. Maybe talk just a little bit about that, how you do that.
Yeah, of course. So, here at Commercial Lending X, we, for lack of a better term, are primarily a commercial loan brokerage shop. We do some direct hard money, private money lending, but what we're doing is taking our clients in. We have our own underwriting department, really underwriting and understanding their situation financially fully, and then trying to position the request in the best way possible. So mitigate the risks that exist, and then take them out to the lending market and to the right lenders. So that not only the right institutions, but the right lenders at those institutions with a very clean and complete package. Don't hide the negatives, mitigate the negatives. And sometimes that is, telling borrowers the hard truth that you may not qualify for bank financing right now, but there's plenty of non-bank lenders, alternative financing solutions out there. And it's about finding the best fit to get you through this next phase, and then hopefully get those borrowers back into more traditional banking at a future date.
Yeah. And, Brad, some of the feedback I've gotten from people that I've referred to you is just the fact that you're not just a one-trick pony. You're not, it's not one size fits all, but your programs and your consultative approach is really personal. And I think that makes people feel validated in the direction that they choose once they have that kind of information.
Well, thank you for that. But I mean, honestly, that's my goal. We're not going to be a solution to everybody. There's some people we can't help. Some people, we can't help them the way they want to be helped, and we're going to be honest about that. And then others, there's options out there that are maybe even better than what they thought was available. Even though SBA 7A rates, as an example, are still high today and variable. The good news going into this year is they're likely to come back down, as the Fed has indicated they're likely to lower rates this year. But, there's a lot of creative things you can do with that product to consolidate that, refinance that, get it extended out on 10 years or up to 25 years if real estate's involved. So there's some creative ways sometimes you can use products out there to really help clients that they just may not be aware that exist.
That's great. So Brad, before we get into 2024 and kind of just your view on that, talk a little bit about your process to people engage with you. I know there's the initial consult that they have with you, but then talk just a little bit about how that works.
Yeah, so we have a process here. We call it the CLX way, which is a 6-step process. Starts with an initial consultation. We then do an onboarding where we gather initial financial information. In that stage, if they're looking for pre-qualification to buy a property or to buy a business, we can do that either for them individually, or we can do that for the specific property or business they're looking at. We then have our own in-house underwriting where we underwrite the deal and identify any issues. We then take it to market, manage it through the lender process initially to get terms and to get it all the way through to approval, and then continue to stay involved on the path to closing, our 5th step, and manage it through the closing process. Really being sure everything comes together and aligns with the terms of the approval. And then finally getting to a closing. And we work purely on a success fee basis here. So we don't get paid unless clients accept financing we get for them and close on that financing. So we're relatively low risk to our clients. All the services we provide in between with the onboarding, pre-approval, underwriting doesn't come at a cost. We only get paid if we're successful. So because of that, we don't take deals on that we're not confident that we can get done.
Yeah. And Brad, speaking of that, if a person's serious about getting into or is already in the commercial game, it may not be necessary for them to engage you only when they have a deal, right? But to start talking with you beforehand so they can set the table appropriately.
Hey, thanks for listening to the People Not Titles podcast. We are brought to you by our great sponsors, Land Trust Title Services, your partners for results.
Yeah, so that's actually our recommendation. Like if somebody's looking to buy properties or looking to buy a business or do something else, the sooner they get in touch with us, we can do that initial onboarding, do a pre-approval form. As I always tell people, when you're going to buy a piece of real estate or you're going to go buy the business, last thing you want to do is get a contract on it, take it to lenders, and then find out it's not financeable the way you thought it was going to be.
Absolutely.
Right? You're much better off to get it vetted out, know how a lender is going to look at it. Sometimes we may be telling you we can't get you the debt you think you want for that business or property, but you're better off to know that in advance. And there's also sometimes some creative ways, especially on business acquisitions, where you can have sellers carry debt or you can do other things to make a deal work that may not otherwise work. So the sooner you start working on that, the better.
Awesome. All right, Brad, thank you for that. Let's get into 2024 and let's talk just a little bit about what you're seeing, for 2024 and what some of our, constituency out there can be expecting.
Yeah. So 3 days in, 2 business days or 1.5 business days at this point, it's hard to say for sure. What I suspect is going to happen, as the Fed has indicated, they think that they may have up to 3 rate cuts this year. I would not expect those to be more than 1/4 point at this stage, but that could change very quickly if the economy downgrades. But I would expect probably about 75 basis points in relief, in interest rates from the Fed this year. Could be more again if the economy kind of struggles. It is an election year, so I think that there's going to be a little bit more pressure on the Fed to keep economic conditions on a flat footing at least. So it could be more if there's any signs of weakness. From a banking perspective, I'm not 100% sure what I would expect. We did see a lot of banks at the end of last year pull goals back from lenders, slam the brakes on lending. It's a new year. Banks are only going to make money if they've got debt on the street. So I think we're going to see, at least in the front part of this year, credit open back up some. I don't think it's going to be super aggressive. And there's going to continue to be weakness on the lending side from certain assets that are deemed higher risk, specifically office buildings and retail buildings. I think there's going to continue to be some high risk there. There's a lot of that debt that is of concern right now. But overall, I think it's going to be an active year, and I think transactions are going to get done that make sense, and those that don't, they're going to have to use alternative financing.
Great. And what I hear you saying is that it may be better if you're considering getting active, it may be better to get active at the beginning of the year than later in the year.
Yeah, I would definitely recommend earlier in the year. And if you're sensing you're going to have any trouble or pushback from your institution, you're not getting the same warm and fuzzy feelings you did a year or two ago, and you're going to think about looking for alternatives, I would start doing that sooner in the year than later. Of course, it's always weird in the first quarter for operating businesses because nobody has their tax returns done yet. And a lot of lenders want to see what that actual tax performance was for 2023. But I would agree sooner the better, especially if you've got maturities later in the year. And if you do own assets in some of those classes like office and retail, where it is going to be harder to get renewals done, you definitely want to start working on that and exploring your options sooner so you have more time to secure something.
Great. Thank you, Brad. And finally, Brad, your memo to everyone talked about bank failures last year. And it was Silicon Valley Bank, Signature Bank, and then First Republic became the second largest bank failure in the U.S. And so that, honestly, that kind of went under the radar for most people because there was all kinds of other issues that they were dealing with, right? The housing market and all these different things. Do you see the potential for more bank failure in 2024? Do you think that's kind of gone away?
Yeah, so I think the Federal Reserve, with some of the changes they made, has alleviated a lot of the immediate risk banks were feeling. There still are some institutions struggling from both a deposit and a capital standpoint, and I think they will continue to struggle. Is there likely to be a few more failures this year? I mean, outside of a rare year, there's always some sort of institution that fails for some sort of reason. But I don't expect it to be broad-based. Now, again, that could certainly change if the economy tanks or if inflation rears its head again and the Fed has to go the other way and raise interest rates even further, and you start to see a lot of loan defaults, that could have a material impact on a lot of community banks and even regional banks. And kind of the overhang that's on the industry as a whole, as I already mentioned, retail and office, but for your larger regional banks, they have a lot of exposure to large office and retail. And I am hearing that a lot of big investors, big funds are just turning back keys on large office buildings throughout the country, especially in some major metropolitan areas. And a lot of these buildings, I heard of one the other day that it was acquired and valued at $45 million in 2019, and the bank gave the keys back, and the bank's selling it for $10 million. Whoa. So that's 20% or 25% of value. So I do think some banks are going to take some big lumps there. The good news is banks have higher capital today than they ever had before. They have larger loan loss reserves than they did prior to 17 and 18. So I'm not expecting a ton of bank failures, but a few are possible.
Yeah, and banks made a lot of money as it was running up, right? And so if they've hung on to some of that, they're going to, they view this as part of it. But I know this is a little more extreme than they were hoping for sure.
Yeah, so it's kind of funny because rates went all the way down. So a lot of banks are stuck with a lot of assets at low interest rates. Then they came shooting up, but deposit rates didn't move initially. So we saw margins at banks just skyrocket on the net interest margins. Then last year, banks needed to raise more deposits. They saw deposit runoff. They had to quickly raise interest rates to do that, compressed margins again a little bit. I think margins are going to remain a little bit compressed, and interest rates are going to remain a bit above market at banks this year as well. But overall, I think the industry is still relatively healthy. They're hoping for more time with deposit rates staying low than they got.
Yeah, they were hoping to skim some off the top there and enjoy the, like the consumer wasn't aware. But once one bank starts to put it out there, right, all of a sudden everyone has to meet the market.
Yeah, And so I do expect we're going to see earnings this year be down compared to last year in the banking industry, but they should still be positive. Again, absent something coming out of the woodworks, like another COVID or something crazy like that.
Yeah. Well, okay, Brad, I just want to say thank you for the update. I love it. I actually am hoping to do this more often with you, just because of your insight and all that, and because I think, I get a lot of questions from everybody, so it's great to be able to put this out there. And then naturally, we'll have your contact information so that if someone has a question regarding some opportunity that you can help them with, they can certainly reach out to you.
No, happy to, and I really appreciate the opportunity to be on. And just a counter question for you, if I may, but we talked about the financing side, but what are you seeing? Any major changes in the title world in 2024?
Well, one of the things that we have seen most recently is just some of the bigger underwriters there was these hacks. You had this was just at the end of this year. And so I think that, that there is a concern there from a security standpoint for all of us from an IT standpoint of just saying, how do we make sure that we are, going to be functional and operational and all that kind of thing. So that was kind of a weird thing that happened at the end of the year. But other than that, I think there's optimism from the residential side. There's real optimism heading into 2024. We're ready. We already had a kind of a great December, and we see a lot of activity going into this. And so I think that I think that we're going to have a much better year than we did in 2023 on the residential side. And then commercial, you got your finger on the pulse of it. So.
Yeah, I definitely hope that's the case. One other thing I'll point out, I think values, a lot of real estate owners have held values high. So we've had a lot of clients that just can't make deals work with what people are asking on the commercial side. Maybe that's part of the deal with the residential too. Residential rates have come down. My only concern with where interest rates are going is we're still in an inverted yield curve where short-term interest rates are higher than long-term rates. So I am a bit fearful that even if the Fed lowers short-term rates, that long-term rates may continue to stay somewhat elevated as that yield curve corrects itself. Maybe I will be wrong about that, and maybe that won't happen, and we'll see long-term rates plummet down as well. But I definitely hope there's relief on the consumer side. So,
yeah. And I think that you're starting to get the consumer to swallow the fact that we were in a unique period of time where rates were really low. And for all of our history of being in just life, right, those were just extraordinarily and unusually low. And this is more normal. And so, once you have the consumer accepting it, and the further away we are from 2 to 3% interest rates, the more we can swallow 5, 6, and 7s even. And I'm not saying that's going to remain here forever. That's my hope. And I know that a lot of consumers have these great cherry mortgages that are at 2 and 3%, but you're starting to see more that pressure of people having to move, people outgrowing their home, people wanting to upgrade or downsize, and they're just going to do it and have kind of priced it in and accepted the horse pill that those payments they enjoyed with the lower fixed rates are just not going to be going forward for quite some time. And so that's I think is the market adjustment in mindset more than anything.
Yeah. Nope, I would agree with you 100%.
Awesome. All right, Brad, thank you so much. Blessings to you and your family as we head into 2024. And I look forward to staying in touch with you. And we really appreciate you as a resource.
No problem. Always a pleasure to talk to you and work with you. And hope everybody has a wonderful 2024.
Take care, my friend.
Hey, thanks for listening to the People Not Titles podcast. We are proudly sponsored by Land Trust Title Services. If you enjoyed the podcast, please hit the like button. Please subscribe, and we'd love it if you'd share our podcast with your friends. Thanks a lot.